All right, let's jump right into this explainer. Today, we're figuring out exactly how the financial world actually measures the sustainability and, honestly, the ethics of the people managing your money. We're going to unpack a foundational framework that impacts almost every investor out there. Whether you've got a modest retirement account or you're managing a massive institutional fund, this matters. We're looking at the definitive hard and fast standards that hold asset managers accountable.
To really grasp how this works, we first need to look at the Sustainable Industry Classification System, better known as SICS. Think of SICS like this massive, incredibly detailed geographic map of the global economy. It categorizes industries based on their unique sustainability risks and opportunities, basically the real-world factors that can materially affect a company's cash flows or their cost of capital. And today, we are zooming way in on the financial sector of this giant map to pinpoint one very specific set of coordinates.
And those exact coordinates, they're FNAC. That stands for Asset Management and Custody Activities. This code right here is the absolute foundational classification for this industry. So whenever you hear FNAC, you'll know we're talking about the strict, standardized rules governing how asset and wealth managers have to report on their sustainability, their ethics, and their environmental impact.
So here's our roadmap for today. Number 1, meet the SICS framework. 2, defining asset management. 3, the 5 sustainability pillars. 4, trust, ethics, and people. 5, investing and the environment. And finally, number 6, why FNAC matters. Okay, part 1, meet the SICS framework. So, this framework carries some serious global weight. Back in August 2022, the International Sustainability Standards Board, the ISSB, actually stepped up and took responsibility for the SASB standards, officially integrating them right into the IFRS Foundation. What does that mean for us? It means this isn't just some localized, optional guideline. It's a system that dictates international financial reporting across the globe. Moving on to part 2, defining asset management. So who exactly are we talking about here? Well, these entities range from those giant, multi-jurisdictional money managers all the way down to small, niche boutiques. But they all share a common thread. They provide essential services to help everyone from everyday retail investors to massive institutions hit their financial goals. We're talking about firms managing portfolios on a fee basis, wealth management advisors, retail securities brokers, and even private equity and venture capital firms. Simply put, if they hold or manage your financial assets, they are very likely playing under the FNAC rules.
Now, what's really fascinating here is how differently these firms compete based on their size. The industry giants, they're basically fighting tooth and nail over management fees and pure raw performance metrics to attract those massive institutional clients. On the flip side, the smaller boutique firms win by offering highly tailored, customized products to meet very specific diversification needs. But here's the kicker. Regardless of their size or their competitive strategy, the SICS framework holds every single one of them to the exact same stringent reporting standards.
Section 3, the 5 sustainability pillars. Here is the crucial takeaway. To be considered a truly sustainable asset manager, a firm has to prove its competence across 5 distinct, highly measurable topics. They can't just be good at one thing and sweep the rest under the rug, right? They're evaluated on providing transparent information and fair advice, ensuring employee diversity and inclusion, effectively incorporating ESG factors into their actual investment strategies, tracking their financed greenhouse gas emissions, and maintaining ironclad business ethics. Every single one of these 5 pillars has specific, rigorous metrics that must be reported to the public.
Which brings us to part 4, trust, ethics, and people. Because these firms are in this fierce, constant competition for top talent, the standard actually forces them to break down their diversity data across 4 strict categories to prove they are actively widening their candidate pools. It's not enough to just vaguely say, hey, we have a diverse workforce. FNAC demands the granular data. They have to report representation at the executive management level, the chief executives calling the shots, all the way down through non-executive management, highly skilled professionals, and all other employees. And it makes sense because expanding candidate pools is empirically proven to reduce hiring costs and boost overall operational efficiency. Firms literally have to fill out detailed tables tracking the exact percentages of women, men, and undisclosed genders at every single tier of management we just mentioned. And it doesn't stop at gender. They are also required to track broader diversity group representation, which can include race, ethnicity, or age. It's all about ensuring that equitable representation is systematically measured rather than just being some empty PR promise.
And it goes deeper than just hiring.
Under the business ethics and fair advice pillars, firms are forced to disclose all monetary losses from any adjudicative proceeding. What does that mean? It means a formal legal or regulatory process, like a trial or arbitration. Basically, they have to prove exactly how much their mistakes or unethical behaviors actually cost them in dollars and cents. If an asset manager gets hit with a fine for false advertising, overcharging clients, insider trading, or market manipulation, the total monetary losses from those lawsuits have to be laid completely bare. It's a direct, unhittable measure of their professional integrity.
Section 5. Investing and the environment.
100%. That massive number represents the target percentage of total assets under management that a firm should be including in its financed emissions calculations. If a firm tries to include anything less than 100%, the FN Act standard forces them to publicly explain those exclusions, meaning they have to detail exactly what assets they left out of the math and exactly why they did it.
Because here's the reality check. An asset manager cannot just point to their LEED certified corporate office and claim they're green. No way. They are held fully accountable for the emissions generated by the companies their portfolios actually fund. They must calculate their absolute gross financed emissions across Scope 1, 2, and 3. That means tracking everything from the direct operations of the businesses they invest in to indirect energy use all the way down their wider value chain. Look, if a fund manager is pouring billions of your dollars into companies that are about to face strict new carbon taxes, that is a massive, hidden financial risk. Measuring these financed emissions forces that risk out into the open.
Now, if a firm finds out an investee is totally dropping the ball on environmental or social issues, they don't just immediately dump the stock. They're evaluated on a strict step-by-step escalation process. First, they express their concerns directly to corporate boards. If they get ignored, step 2. They team up with other investors to increase the pressure. If the company still won't budge, step 3 is going public or filing shareholder resolutions, and ultimately, it culminates in the final, nuclear option, pulling their investment entirely. It perfectly demonstrates active ownership, proving the asset manager is genuinely working to protect long-term value.
Finally, Section 6, why FNAC matters.
You know, the 2008 financial crisis proved exactly what happens when we don't ask the hard questions about risk, ethics, and fair advice. FINAC is literally the tool designed to prevent history from repeating itself, aligning the asset manager's interests directly with yours. So I'll leave you with this provocative thought. The next time you sit down to review your pension, your 401k, or your personal investment portfolio, are you absolutely confident your managers are playing by the rules of FINAC? Thanks for joining me on this explainer, and remember to keep asking the right questions about exactly where your money goes.